Okay, so this is a good paper. We knew that recessions that coincide with financial crises tend to be particularly nasty on average. This paper exploits cross-sectional variation around the average, connects it to credit spreads, a couple of other things, and really sharpens what we know about how financial crises and macroeconomic activity are connected. Okay, good data, nice paper. My comments, I want to talk about some of the broader implications of the results. I want to compare their results to some other papers, particularly this Romer and Romer paper that reached fairly different conclusions, and then I've got kind of a laundry list of details that I probably won't get to that are mostly, I hope the authors find useful. So, broad implications. What do we learn? What did we know? Recessions that feature financial crises are relatively deep and long-lasting. So what's new here, in addition to a bunch of other things, one of the central results is recessions that feature severe financial crises are severely deep and long-lasting. Okay? So what I want to talk about is, does this strengthen the case for causality? Okay, this is kind of, at the end of the day, why we really care about this stuff, right? Do financial crises cause or at least amplify recessions? If you think about it, the case is pretty compelling, right? We've got centuries of data that looks like, that makes a case where we want to really point to the crisis as the smoking gun. We've got models, lots of models in which, that represent a kind of a causal or an amplification mechanism. At the core of this paper is this narrative about a particular class of models, models of credit crunches, models of a disruption in intermediation. Okay, they use this he and Krishnamurthy paper as sort of a benchmark. The paper argues that the results are consistent with that class of models. So in a way, I would say that this paper is strengthening the case for causality, and I kind of agree with that. What I want to talk about is some other data for which the answer is, maybe not. There's this class of models has some problems with. Okay, so the first point is a very well-known point. In aggregate, firms finance themselves internally. Okay, so that red line, that's net income plus depreciation minus the change in working capital. There's CapEx, the blue line. The difference is free cash flow. Okay, so the aggregate firm, these models are models of the disruption of intermediation. And for the aggregate firm, there's nothing to disrupt. Okay, so that's a challenge for this class of models. Now, this is a pretty well-known graph. Forgive me for those of you who have seen it lots and lots of times, but I really think it's an important point to make here, right? That the credit crunch story for why the crises make recessions worse, it's a problem for that story is that lots of firms finance themselves internally, something that's of course pretty comfortable to a lot of people in this room. Am I saying that there are no firms that are financially constrained? Of course not. Okay, but don't forget, this paper isn't about spreads and small business lending. This is about spreads and GDP. Okay, it would be nice if we had a model that could account for this and could account for, could look into those firms that might be financially constrained. So let me give a plug to a colleague of mine. Ariel Zetlin-Jones and Ali Shoradeh have a very nice paper, I think, that points out first that this graph here is much more about public firms. You look at private firms and it kind of reverses itself. Private firms rely on external financing a lot. Okay, so these guys, they write down a model. You got public firms, private firms, big sort of financial crisis-like shock to the financially constrained private firms and ask what happens to output, and the answer is a fair bit, but nowhere near what we need in order to really account for the big movements that we see. So, second thing I want to talk to in sort of a broad perspective is spreads. Okay, there's a very strong narrative running through this paper, okay, in terms of what is the right spread. And here's how it goes. Crisis severity is, how does this work? Sorry, I can't find the pointer. I'll do without it. Crisis severity is phi, okay, and phi is a product of Z and F. Z is like a shock, okay, house prices fall. F is fragility. Higher crisis severity with a big shock and a lot of fragility. Spreads are a proxy for crisis severity, okay, the way this paper's written. Fragility is not the fragility of homeowners or the fragility of Apple Computer or governments, it's the fragility of the financial systems, banks. Okay, so that says that the right spread here is an intermediation spread. Okay, so what does the data have to say about that? Is the data consistent with this being an intermediation spread? Here's a kind of a back of the envelope answer, the best I could sort of come up with on short notice. My intermediation spread is triple B corporate bond yields, 2-year, minus a US Treasury yield of similar maturity. Okay, this picture doesn't look that different, a little less pronounced for AAA. Okay, so we can talk about, you know, why not a shorter term one. There's a bunch of problems there. It's the best I could come up with. So do you see a big spike in spreads associated with just this one episode, the crisis? Yeah, that's the gray line in the middle. Okay, but is it big enough? I don't know. Moreover, the models are really driven by a big increase in the lending rate. That's the blue line at the top. Does that spike up enough to be sort of consistent with a big mechanism in the models? I don't know. And then moreover, the spread's being driven more by a decrease in the funding rate than an increase in the lending rate. Is that consistent with a bunch of these, with these models? I don't know. Comment, in this paper, it would be nice to, this paper's about changes in spreads, forecasting GDP. It would be nice to decompose what part of the change in spreads is coming from the bottom and the top. I think that could drill us in a little bit more on financial shocks versus macro shocks. It's going to be a sort of a theme of my comments here. Turning to the spreads that this paper uses, they're corporate spreads. Okay, Moody's BAA minus AAA. Right, so this is clearly the wrong spread for this sort of question that the paper sets out to answer. You know, this spread is probably affected by credit disruption. Okay, but of course it's affected by lots of other things, corporate default rates in crises and stuff. And you can kind of see that here. Instead of a big spike in the lending rate that we kind of saw before, these lines in the top are kind of moving together, and the spread itself is spiking because they're moving together at different rates. Why does the paper use this? I think that's probably clear from Tyler's presentation, out of necessity. Right? They want to use data going back into the 19th century, and this is kind of the only game in town. But we ought to, you know, the data is what it is. My general point here is that the paper's results, I kind of think of them maybe as being more about using spreads to measure the severity of recessions associated with financial crises than it is about using spreads to measure the severity of the crises themselves, the title of the paper. Okay? More generally, what am I saying? Am I saying that financial crises kind of don't matter for recessions? Of course not. I'm just saying that this class of credit crunch models, that mechanism, there's some data that's important data that challenges it. Okay, my second stuff I want to talk about is some work that comes up with fairly different answers in terms of are financial crises, recessions with financial crises, particularly deep and protracted. And mostly I'm talking about this Romer and Romer paper. Okay, they find that the impact of financial distress in advanced economies is not large. There's a couple other papers that sort of find similar things that Tyler's paper discusses. They say that a moderate crisis is followed by a drop in GDP of 3 or 4%, not 9 or 10 like Reinhardt and Rogoff and this paper. The fall is very rapid. You exclude Japan, the effects are highly temporary. What accounts for the differences between what these guys find and what Muir and Krishnamurthy find, I think, is very instructive and a good way to discuss this paper. So there's kind of two things. One, what matters a lot is whether or not you use data before World War II and from emerging markets. Okay, if you don't, Romer and Romer, it doesn't look like the effects are small. If you do, the effects are big. Okay, so I guess there's sort of two sides to this coin. The Reinhardt and Rogoff story is, this time is going to be different. No, it's not. No matter how advanced societies get, they just tend to lever up and things end in the ashes. And therefore, data from the 19th century is very relevant for understanding this question for us now. The flip side of the coin is, well, okay, maybe that makes sense for sovereign spreads, or for sovereign leverage, for government leverage, household leverage, but for banks? No. Modern day banks, our modern day banking system is much more reliable, much more efficient, much better regulated than 19th century banking systems. And that data back then is just irrelevant. And Romer and Romer's calculations then would be the sort of ones we want to pay attention to for banking. Kind of harder to say with a straight face now than 10 years ago or after Professor Ed Matty's talk earlier, but I think it's believable that banks are different now than they were before. Okay, and then the second big difference is how recessions and financial crises are identified and dated. And so there's a couple of details here. First, there's kind of two. Romer and Romer view the financial crisis as the sort of primary unit of measurement. They go out and identify financial crises in a really interesting way using commentary, kind of real-time commentary for the OECD, and figure out which countries or financial systems are in distress. And then they go and look at what happens to output. Okay, so ex ante. Most of the rest of the literature, Reinhardt and Rogoff, the unit of measurement is a recession. So kind of ex post. We go and we find all the recessions. We classify them as having crises or not. We date when the crises happened, and then we look at the output. Okay, this paper, 80% of it falls into the latter category. I got a comment later that I won't get to, but I think maybe 50% would be a better number. The stuff that isn't sort of ex post recession is really interesting, and I wish I had time to talk about that comment. Anyway, this paper uses ex post. Romer and Romer use ex ante. That's a source of difference. Is that what's going on? Yes and no. What really matters is how you date the crises. Okay, so let me use an example. Norway. The colors work there, right? Green and black. So Norway. I think this is pretty representative of a financial crisis recession in the sample. Okay, especially in that the bank's failing happened sort of late in the game. In fact, given the results, this kind of needs to be representative. So Norway, big oil shock in '86. Country goes into a big recession in '87. House prices fall. Eventually in '91, the big banks go down in the setting of a global recession and Sweden's banking crisis and so on. What matters here is how you date the financial crisis. Is it the red triangle when the banks failed, or is it when the recession started? Okay, so the Schuerlich and Taylor dating that is behind a lot of the results is the financial crisis started when the recession started. Okay, and their results things work a lot better with that dating in the sense that spikes and spreads forecast future GDP a lot better at the beginning of the recession relative to when the banks failed. Okay, so then the paper sort of argues, well, what am I saying? This is a big difference in terms of the papers that find small effects and this paper that finds big effects. It's how you date this. Is it at the beginning or when the banks failed? Which is right? The paper claims the beginning, the Schuerlich and Taylor dating. The behavior of spreads around these dates is most consistent with theoretical crisis models. This I don't get. I asked some of my colleagues who know these models. I really don't. When do the intermediation spreads spike? It's when the banks fail. Now you could claim that actually the banks failed back in '87, and it was just a fait accompli, and that's where the spread spiked then. I don't know. I'll let the authors sort of comment about that if they want to. I guess you could also say you could have a model where spike was kind of anticipatory. A big macro shock hits back in '87. Spreads go up in anticipation of possible future financial turmoil and a failure in the banks. Okay, that makes sense, but I think what has to happen there is that you get another spike when the banks fail. It needs to be a surprise, or the banks would just fail back at the beginning. Okay, so my point here is that by focusing on this dating of the crisis, which is dating of the crisis at the beginning of the recession, we're confounding macro shocks and financial crisis shocks more than we would if we would have incorporated data from when the banks failed. So I'm almost done. For example, you can imagine a world in which financial crises don't play any kind of amplification role, okay, and are just a casualty of a deep recession. Okay, in that case, the spread spiking at the beginning is perfectly consistent with that world. Another world in which the financial crisis plays an amplification role, we would see a spike at the beginning. Then we see a spike when the banks failed as well. Okay, and so that's my kind of point here is by exclusively focusing on these ST dates, we limit the extent to which corporate credit spreads can tell us things about financial crises in addition to the kind of things in recessions that we know they tell us a lot about, corporate default rates and stuff. So here's my other comments. Like I said, I won't have time for them. I just, last thoughts. Is this meant to be a paper about finding variables that explain cross-sectional variation in recessions that feature financial crises? Okay, sometimes it seems like the answer is yes. The authors claim or state we make no claim of causality. So if this is just about explaining cross-sectional variation in these financial crises or recessions, there's a long list of variables you might consider. Credit spreads are at the top. Or the way the paper is written, it certainly seems it's meant to be a paper about doing the above and uncovering new insights about the crisis mechanism. Okay, and clearly that's what the authors are after. And they're on the right track, but there's a bunch of challenges from the data I talked about, and the challenges from the fact that their hands are tied in terms of using these corporate credit spreads. That's all I have to say.